This webinar series is about transparency in the financial market, in economy, ethics, law, and practice. The title of this webinar is Market Economy, Democracy and Inequality. How does your money end up in tax havens? The confidence in our democracy, our tax systems, and also our financial markets can only be maintained if there is trust. But who develops the rules that decides if companies, financial institutions, and also ordinary people pay tax, and how they might maneuver in order not to pay tax? Which actors really has influence on formulating tax policy and for whom it might apply? And how can public sector effectively protect the public interest? Today there's a large market for advising companies in how to take advantage of international tax law and on a tax implication of different global structures. In this webinar, we will more specifically try to find out how rather obscure changes in accounting concepts have contributed to significantly larger uncertainties in the financial market, and also how it is possible to earn dividends on unrealized profits. We will try to understand how this may affect companies, financial institutions, and also ordinary citizens. We will also try to understand how such changes affect the public sector, the service delivery to us citizens, and the inequality between people. Or what would happen if public sector start using the same mechanisms as what we're seeing happening in the private sector? So please, I would like to introduce the three experts who would help us to take the big dive into the rabbit hole of accounting practice. And with us today, we have Frian Aarsnes. You're a state authorized public accountant. You have worked both in large audit firms, extractive industries, large oil and gas companies, and you have been in international consulting since 2005. We have with us Fanny Voldnes, the Director of Political Science Department at the Norwegian Union of Municipal and General Employees, known as Fagforbundet in Norwegian, and you're also an accountant. In addition, we have with us Rolf Aaberge. You're Professor II at ESOP, the Center of Excellence at the Department of Economics, University in Oslo. You're also researcher at Statistics in Norway. I know you also have a lot of mathematics, at least 7 years in your background in order to interpret all of this. So with the help of these experts, we are trying to get into the rabbit hole. So in the last webinar, we were talking about the law, the rule of law, or navigating between laws, and financial decisions. And accountancy was described as the hybrid, the kind of mysterious thing, and it is not the tax law. Can you explain to us what exactly are accountancy rules?
Accountancy rules are the rules by which companies will have to close their accounts, book all their transactions, and present their financial statements to the public. So it's about how information is divulged from companies.
There was a prize-winning economist, Robert Shiller. He defined finance as the science of goal architecture, of structuring the economic arrangement necessary to achieve a set of goals, and the stewardship of assets needed for this achievement. When and where exactly does accounting rules come into play?
Accounting rules comes into play not only for companies but also for contracts that they enter into. and thereby also all the transactions that they are undertaking. And when you get into transactions, you get also end users into the game, and that is where it affects people in general.
I know this is a big question, but could you give us a brief overview of the who is who in the when it comes to developing accountancy rules internationally?
There are two organizations which are tightly knit together. It's the IASB, International Accounting Standards Boards, and IFRS Foundation is the International Financial Reporting Standards Foundation. These are two private organizations which is mostly then auditors, which are setting up new standards, adjusting existing standards, etc., to develop the accountancy rules where they believe it should be. And not many years ago there was a huge change where previously the focus was on getting the profit and loss statement each year correct, and this has now turned over to getting the balance sheet correct, so focusing on getting the value of the assets correct.
But providing tax and international service to companies and wealthy individuals is a huge industry. But how does this affect us in society?
There are many different accounting rules that is affecting the individual, but one of the most marked ones is a concept called Marktomarket, whereby transactions and assets are valued at their fair value, and thereby you have transactions that can change their value depending on at what time they are measured, and also pricing of services, which can then differ at the different time that they are delivered from the company.
So when we talk about an asset, it seems that there might not be any clear definition of what it is or how we value it.
And that's quite correct. When you buy something, you have a clear and definite price for it. And previous accounting was accounting at historical value, i.e. the value that you had when you bought it. When you introduce fair value accounting, you change that value, and that value is based on a price that is expected to be achieved in the future, and depending on how long time you are thinking of taking in the value, how you are measuring it, the methodologies, the models that you're using, you can clearly not define any value as such anymore. Each individual person that is valuing it will come up with different values. So you have lost all contact with what value is really about. So 10 different companies with 20 different people will have 20 different value settings on one and the same asset.
But that sounds quite startling. How does that affect financial markets then?
It affects financial markets in quite astonishing ways. First, it means that companies will adjust up in good times. They will adjust up the value of their assets, and they will be shown as more solid than they are with historical cost. They will have the possibility of dividending out part of the value increase that they have put on their assets. And the last but not least, when the markets turn down again, they risk not having the solidity and robustness to take in the downturn of markets, and companies can actually go bankrupt, and they have in the past. Enron was one of these companies that actually went bankrupt based on these principles.
But the connection to the market, so if a company is in a so-called true marketplace, it can be okay. But if it's done in a marketplace where companies are not in a so-called true marketplace or including low tax jurisdictions, it becomes problematic?
Yes, in addition to the fact that you can have these up and down turns in value, when you introduce low or no tax jurisdictions, most often called tax havens, you also introduce Marktomarket as a mechanism where you can transfer enormous amounts of money out of countries due to that you can set up transactions based on just that you adjust the value of the asset, and this can take almost all the profit out of companies in high tax countries and transfer it to low tax countries.
But it sounds as if what we might imagine, this could be something, a little shady part of the economy, but in reality this is the economy.
Yes, the last 30 years this has become more and more the economy. Previously these principles was limited to a few industries, but with the development of a huge class of accountancy rules and mechanisms through financial institutions, derivatives, mark-to-market, this has become quite persuasive in the entire economy, and most companies use these concepts and principles on a daily basis without actually noticing it.
Can we go a little bit back to tax havens for all those who are not so familiar with the tax havens? How exactly does tax havens come into play with such mechanisms?
Well, the mechanism is that you set up companies inside a group of companies, and these are then transferred rights and assets, and then you do a mark-to-market contract with a buyer inside the corporation in another country, and when you then hook the pricing of that asset to a market and the market goes up, the price in the buying company in the group receives a higher price, and since the price is linked to the market, when that company is then selling onward out of the group, they will not have that high earnings anymore over and above the cost that they have paid.
So it's particularly harmful when you use tax havens in mark-to-market contracts?
Yes, and this is almost always the case. Large multinational companies are almost always organized such that they have a number of companies in a tax haven, and even smaller companies like some of the ones we have in Norway, which Fanny will talk more to, are companies that take into account other countries' tax system and also low tax jurisdictions.
But when the use of mark-to-market contracts and tax havens is so prominent in the global economy, what risk does such use present to the global economy?
That is one of the things that I call it the roller coaster mechanism in the global economy, because when things go good, markets are rising, asset values are rising, profits are rising, dividends are rising. But when things crash, markets go down from time to time, you suddenly find yourself faced with an accounting concept that is persuasive across all companies, all industries, and you can find yourself faced with or entire industries, financial industry, other industries that are at risk of losing their entire equity, and thereby that they are risking bankruptcy.
Could you say something more about how big would a risk be to an individual company in a global economy?
That is highly dependent on the management of the company. If the management has been very aggressive with using Marktomarket, has been very aggressive with dividending out the funds that comes with unrealized profits, then the risk is significant because they have taken out a lot of the equity that is based on future earnings, and when those earnings are not realized, then the risk of bankruptcy is high. If the management is managing the company in a better way, keeping funds back, not dividending out so much, then the risk goes down, and that is one of the reasons why one of the mechanisms that can be used is making sure that companies can't dividend out unrealized earnings.
But how can ordinary citizens understand how this might affect them as individuals? Could you give us an example of how can this affect one single person?
There are many examples. I think, although not directly in the market of assets, it is still a market mechanism, and that is how prices of a hotel room, for example, can change over time. So when demand is high, the hotel room, which is the same standard as it was yesterday, can be priced up due to that there is a large football game or something like that, and all the hotel rooms are booked out. So you will see that the price can, for example, double. That was something that you did not see 10 years ago, 15 years ago, where you had the same price for a room. So now a hotel room can go from 2,000 kroner down to 900 in a flash. So that's one example of how it can work. You also have other examples that the others will also come more into, but that is one mechanism that shows how individuals are faced with consequences of this.
But we are able to live without, for example, football game, or some of us, or a hotel room. But how about such mechanisms having an effect on things we are not able to live without? For example, medicine or water or food. Could it get into these domains?
It has already gotten into this, so I think Fanny will talk more about this, but medicine is one of the examples where you see a pricing which is unheard of previously. So medicines that are the companies are trying to sell cross borders with an enormous price. So it actually then is entering people's lives.
And perhaps without us not even knowing about it. How did all this really start? Can you give us some brief overview?
It started when these accountancy organizations went and wanted to change the way investors were taking out money from the corporations. So they ended up flipping the focus from the balance sheet, from the profit and loss statement. Previously, the focus was to get this year's profit and loss statement correct. Now the focus is all on getting the balance sheet correct, so that you are in the balance sheet focusing on the future value of these assets. it pertains to being today's value, because you are taking today's market value and you are changing the assets to their fair value of today's market. But it's really the future market, because the assets are not realized today, so they have to be sold sometime in the future. So you're actually using today's value as a proxy for the future value that it's going to be sold for. And even worse, where you don't have real markets, companies are starting to using models to find the future value, and thereby you have a very theoretical value of the asset.
This sounds very randomly used sometimes, that you can decide for yourself what is the value. Is that the case?
Unfortunately, yes. In clearly defined markets like exchange rates, you will find that there is a market. You can find a value that all the companies will use, but the problem is the timing period that the asset will be sold over. So if you have an asset that is used the next day or the next week or the next month, then today's exchange rate value can possibly be the correct value. But when you then start to see you are valuing assets that are going to be sold over years, and then you are guessing that this value is going to be the value that you are selling it for in the future. And markets can go against you, and they do from time to time. And thereby you end up with a balance sheet of a company that is based on guessing future values. And since you are guessing future values, you're also guessing on the equity that you have, and then the dividend that you pay out from the company is also guessing on the future values of the assets.
But since the perhaps around late 1990s and early 2000, the studies of financialization from a variety of disciplines, they have described how this shift from an industrial economy to finance capitalism has become increasingly autonomous, they often use, and that it has altered not only the logic of the underlying industrial economy, but also the democracy itself. What is it important to understand from an accounting perspective, how it might affect democracy itself?
Difficult question. It's about how companies behave in the world economy. When you are able to change the value of assets, when you're able to dividend out the surplus of a company based on unrealized earnings, then suddenly you're facing society with a number of companies that may be on risk of bankruptcy at the same time, so-called systemic risk. And you also have these companies which is called too big to fail companies, where companies grow so large, and when they utilize these accounting rules, when they are at risk of failing, they are threatening the whole fabric of society. And you have seen governments go in and try to save these institutions. Some go bankrupt, but you can't let them all go bankrupt. So the last financial crisis ended up in governments going in and supporting financial institutions, for example. And then you're taking taxpayers' money to save these institutions.
But this also sounds as it may directly influence individuals. And also perhaps with the robotization, which will, through algorithms, try to make or guess what an individual person is able to pay for a product.
Yes, and that is the next step of this individual pricing, where companies are guessing what you're willing to pay. So, for example, if you are trying to buy an airline ticket, the airline company may look at what other travels you have, whether you are traveling on business, whether you are traveling for leisure, and they may try to price this. And this can be seen when you try several people with several computers, several identities, try to book the same ticket, and you get the same different results. So individual pricing is now fully coming, and that means that each individual will actually have less money available for various transactions than they previously had. When companies are trying to price the service or product towards you for as high as they think you may be willing to pay.
It seems as if the society is not really set up or have the necessary understanding or insight about what to do with this problem, because it evidently decreases individuals' purchasing power, and it can be very harmful for marginalized groups. The principle from a parliament is that the citizens should contribute from their ability, and such principles seem to cease to exist in the light of this. It would be interesting to know something more about how many companies you think are using mechanisms like this in order to see how big is this way of this praxis.
I think now you can see that there is more and more. It has come to banks, it has come, and financial institutions, it has come to airline companies, it has come to hotels, it is way into the medicine industry. So from industry to industry you will see that this comes more and more. So it's already a part of today's society.
But with this type of financial logic, will there not also be a following shift from what you might see as long-term goals to more short-term goals, which is more present in the financial market? Is that correct?
That's very much correct, because when you are taking unrealized earnings out as dividends, you will see that you are essentially not only focused on what you have earned, but you are also taking into account that you have to realize what you have taken out as dividends. So a company is faced with having to short-term realize these values in order to continue their story towards society, towards investors, etc.
It seems like the thinking, which used to be perhaps relevant for the stock exchanges, is now affecting everyday people's lives with a mismatch on a product and what they are capable of paying. But can you say something more about the driving forces behind this?
The driving force is, what should I say? It's a willingness to take future earnings out today and try to reinvest them before you actually have earned them. So there is a focus on trying to get as much money as possible out of the various companies, and this will then have the effect that there is much more stress on each company to perform according to the metrics that they have said that they are going to do.
But around the whole world, there's a lot of capital looking for investment possibilities. What are they looking for today?
Yeah, it's because these dividends are coming out from unrealized earnings and out to investors, and they will try to reinvest. That means that there is a lot of money looking for opportunities. They are looking at the stock market, and that is a driving force why stock markets are going so fast, so high. But they are also trying to get other possibilities, and that is to always try to find other ways to privatize so that you can put private money into assets. So that is some of the push behind trying to privatize some of the public assets that we see in society.
But such consequences seem quite dysfunctional for both state and its citizens, and perhaps the accountancy industry is an industry in need of a reform. Who are in reality holding auditors to account?
They are not held to account, and societies like Norway should try to look at how you can counter these mechanisms, and it's quite easy. The only thing that you have to do is to make sure that you cannot distribute dividends based on unrealized earnings. Accountants will say that these mechanisms are already in place, but there are huge possibilities to hold some of these away from these mechanisms, and therefore unrealized earnings should be forbidden to be used as dividends with no exceptions, and today there are major exceptions.
We learned, particularly in 2013 from the UK, where there was held a hearing that exposed the role of some of the largest accountancy firms, the big four, which is what they call Deloitte, Ernst & Young, KPMG and PwC, that they've been playing roles as tax advisors, and also the nature of tax advice that they have been providing. And also it came up, while these firms employed around 9,000 people around the world at the time, it far outnumbered the people in the States who were trying to do their part of the job. So there seems to be a very heavy weight coming into play when tax rules are written. With this asymmetry in power, are states really up to the tasks of defending the public interest effectively when its resources are so much more limited than those who are enjoyed by the company they should scrutinize?
Probably not, because public authorities have essentially abdicated when it comes to accountancy rules. It's auditors that is changing them. It's auditors that is making new standards. And also when it comes then to taxation, this is starting to becoming quite complicated. So auditors are also engaged in then following up with tax rules. So you see accountants in both creating accountancy rules and the following tax rules.
This leaves me quite worried, Fanny, that we have both accountancy rules being developed and tax rules being developed completely outside any political control, when it has such huge consequences on our societies. And we often see that labor unions are the first line defense in the battle for serious work life and against the negative effects. And we would like to think that this is something that is happening in other countries and not here in Norway. We have a quite good society here in Norway and a very organized society. Do you have any examples of such cross-border takeout of profit from the Norwegian public sector?
Yes, this is not a foreign problem. This is actually very. It's happening all the time in Norway as well. And Frian mentioned the medicine, the expensive medicine that is bought from multinational companies. That's this one type of cross-border transactions that leads money away from Norway. But that's just the transaction way. I've studied a lot of these welfare companies that do take care of a lot of the public services that used to be taken care of by the public themselves. And these big companies, they are organized in big and complicated structures, cross-border structures, and some of them are also owned through tax havens. And it is definitely a problem here as abroad. And examples of this is, for instance, Aleris, the private commercial hospital that do as well child care, and also they do some older care. And they have companies in several countries, and they're owned by the former industrial magnate Wallenberg family in Sweden, and also in a tax haven. And you have several examples of this. You also have the big kindergarten company of Vespira, who was Norwegian owned but was sold abroad, and a lot of money went with that. It was actually yes, they actually took away some money before they sold it, actually. But the last one is Norlandia. That is it's the first Norwegian-owned multinational welfare company, and they do their accounting now for 2016 exactly like Orkla or Hydro or anything else. And it's no additional information in these financial statements that show how this public money is used or spent. It's just the same information like the big business company. So I think this should be of very great concern for a lot of citizens in Norway.
But it sounds evident that citizens in Norway would like to know how public money are being spent and where they end up. Why is this being allowed in Norway?
That's a good question, because I think that is because this is very technical. Accounting is a very technical issue. And as Frian said, it has been monopolized actually. So it's the Ministry of Finance do not have anything with these rules anymore to do. They have left it for the NRS, Norwegian accounting trust, yes, Regnskapsstiftelsen. So when these rules, IFRS, the new international accounting rules, they were implemented in Norway from 2005. There was a big change in the way the accounting, the financial statements are the information in the financial statement. So it's a great lack of information actually from 2005 on.
So if I understand it correctly, it's the accountancy bodies in Norway writing their own rules on what they have to be open about or not?
Actually, they do the accounting rules, or not the law, not the paragraph of law, but the level beyond.
Mm-hmm.
They do, and also the standards, actually.
But if this is harmful for society in any way, why is it happening? Why is public sector opened up to this?
It's an international trend, and I think that the push for driving more efficient public services, or more efficiency into the public services, this was a tool that some politicians thought that would be better for the services. But there's no doubt that the research that has been done on this, on the consequences, both in New Zealand and Norway and Sweden and Denmark, shows that there is no economic savings for the society in doing this, and the only thing that is the result that is very clear is that the wages of the employees are lowered, and the pension of the workers or the employees are also lowered. The quality of the pension is lowered. So that's the only consequences that is shown by through research.
But what are the processes behind this? Why is it happening? Can you say something more about what you have seen? Which are the processes behind this?
Yes, as I said, this is very technical, and I think politicians, a lot of politicians are not aware of the consequences, and definitely not when this started. But yet now, the consequences are they see the consequences, and it's we see some more interest for this subject now than we used to do 10 years ago or 5 years ago. But even though the politicians, this is very hard for them because of the monopolized item with accounting, and as well these big welfare companies, they are pretty strong lobbyists, so it's not so easy to rearrange this. But the union has claimed that it's a reasonable demand for citizens in Norway to know how public money actually is spent. So we hope that this will lead to some changes.
But could you give us an example on how such accounting rules have affected? You mentioned children, and you mentioned elderly people. How does it affect an older person? Can you give me an example? An
older person, perhaps one good example is what happened with the hospitals in Norway, if that might be an example. Mm-hmm. Because we had a reform in the healthcare in Norway, and the hospital were transferred from the regional level to the national level. But the most important thing with this reform was that the hospitals moved from doing their accounting like municipals do today, actually, to the business accounting system. So we see in the financial statement for the companies that the lift in the assets that this led to caused big deficit in all the hospitals, and this is mainly because of the new accounting valuation system. And we did some research on this in LO, and Bjarne Jensen, a professor in economic, he did a study and showed that no hospitals would have deficit if they had followed the same rules as they used to when they were on the regional level. So this shows actually how the rules, the consequences of using these rules. And a Swedish economist in Lund University, and she's also a member of the parliament in Sweden for the Conservatives. She has actually said that limited companies like our hospitals that are SOEs or state-owned enterprises, but she said that limited companies should not be used to produce welfare or wealth care services, because they're not meant for it. They're meant for measuring earnings gain, and not for wealth care that is meant to serve the citizens' need of basic services.
But Rolf Aaberge, ok, beklager, vi må ta en liten kutt her for å slippe ut en person. Beklager.
Garanterer det her blir klippet vekk i
Det er jo nå alt det må.
Jeg skal på skatteføre som er på Stortinget.
But this is a wanted political development, is it not? It is what we have decided as a society in a way, that this is okay then.
Yes, it's a political wanted change, but I don't know if people actually are aware of the difference between these public services and why they have been produced by the public themselves for 70 years. It has been a political consensus of this situation, and the reason for this is that such services as healthcare, school, all kind of education is so important for society that they are not going to be looked upon as market services. So that's why these services have been treated different than all business and companies. This has been a bit changed the last 20-30 years, and now the government that we have now, they actually speak specially, they say directly that private and public services are going to be seen as just the same. So that's a big change, and also a change in attitude towards the public services. But it's a wanted change.
Which buffers do we have in our society? Because most people would like to know what they get for their tax money in the level of service delivery. It's our tax money.
Yes, there are. Some of us have tried to show how that it's a reasonable demand, that we as citizens know actually how the public money, our tax money is spent, and that is not possible today because there is no transparency in this information from these private commercial companies that produce these services, and the transactions that are done in municipals are not transparent either. So this is not so easy, even though we try to promote some concrete paragraph laws to change the information, but this is just the information, so that citizens may be aware of or learn learn that this is actually happening. But not today. It's not possible to see how this public money that go to these to these commercial companies that do these services. It's not possible to follow the money.
So when I pay tax, these will be distributed to companies where it is not possible to follow the money.
Definitely.
Rolf Aaberge, you are a professor at ESOP, the Center of Excellence at the Department of Economics, and also a researcher as Statistic Norway. Norway is one of the most equal countries in the world. We are living fairly good lives in Norway compared to many other countries in the world, and inequality is not seen by many as the biggest problem we have. But what have you found out about inequality in your research?
Inequality and income inequality is there are many concepts actually, and let me try to explain what is normally meant by income inequality. It's based on what we earn from the market. So most people have a job and they earn their money as wage workers. Mm-hmm. So earnings is a major part. Savings in banks, and they might have stocks, and they get dividends. So altogether that defines the capital income. You might also, some people have their own firms, and they have might have self-employment income, or they might get dividends as well. So altogether, this is the market income from the market. And what we know from the market, even in Norway, is that it's relatively high inequality in the market incomes. Less in Norway than in many other countries, less than in the US and so on, but really I would say high income inequality. So if we stop there, then Norway would be a completely different country than what it is. So here we come to the policy, because even though policy might affect the distribution of earnings, of wage income, and even capital income, as I say, it's very high inequality. But important policy is taxation, the design of the tax system, and transfers that we receive from the government, cash transfers. So the tax system is progressive, which means that the higher income you have, the higher is your average tax. So you don't pay the same average tax, average as a function of your total income. You pay actually a higher fraction of your income, the higher the income is. That's the progressive system. So if we start with the market income, we subtract the taxes and we add the cash transfers, then we get what we call income after tax. That's the common concept used in public statistics. That's what's used by the European Statistical Agency, Eurostat, where they compare European countries. So people have probably heard about the Gini coefficient, which is a measure of inequality. And it's this concept that is used. But first we start to collect all the money in each household. So it's the household that is the economic unit. That's also important to know. Then it's distributed among all the members. And where we take into account that there is scale economics in consumption. Because, you know, if there are 2 adults and 3 children, you don't need 5 cars, or even 2 maybe. And there is, you have an advantage in terms of housing. So it's much more costly for a single individual and for a couple, couple without children, for example, per adult. So we take that into account when we calculate the income inequality based on this cash income concept. And you know, if you use that, which is the standard, then Norway is one of the countries with the lowest inequality. But it has increased. Actually, slowly, every year, approximately every year since 1980. So we had much lower in income inequality in the 50s and 60s and 70s. And this decline in income inequality started with the war, actually in 1940. And it went on after the war until 1980. Stabilized to one point. But the interesting thing is that during the last almost 40 years, it has increased. Not significantly every year, but nevertheless, if you aggregate over such a long period, this is a substantial increase in inequality. So, of course, if it goes on like that, then we might end up in a situation comparable with the situation before the war, the Second World War. But the future is hard to predict. Although I know economists are doing a lot of predictions about the future, I don't believe in it. So it's hard to say. But let me just add a few things here, because I said that this income concept, income after tax, is based on all the incomes we receive, the cash incomes, from our own work and from savings and so on. But we subtract the tax. The interesting thing is that the people should ask is that, okay, but the tax is used for some purpose. Yeah, it's used for this university, for example. And it's used for public services, overall public services. So we get it back. So we might ask, why is it not included in income distribution studies? Well, it's not standard to do it, but we have been working in my research group at Statistics Norway. We've been working on this for the last 15 years. So we know a lot more about the effect of public services on income inequality, and it's really significant. So it has a very strong redistribution effect. It's not only in Norway, actually, it's also the case in other European countries. Although the systems varies a lot in scope and design. So even the Swedish system are different from the Norwegian, but they all have very strong redistributional effect.
So you see that the existence of municipalities and the tax system basically is a buffer, or it equalizes inequality in our society?
Absolutely. So what we call the welfare state, this is really what defines the welfare state, actually. So it has a huge effect. So this is why that even though the income inequality increases in terms of when we restrict to income after tax, the total level of inequality is considerably lower due to public services.
But when we hear from Frian and Fanny that the results of the financial market has an effect on inequality, can we pick that up somewhere in the research, or is it possible to do research on that?
we can do it partly, at least. This is also a question of measurement, of course, but financial markets has an impact, both directly and indirectly. First of all, they directly, because they contribute to opportunities to earn huge capital incomes. And the increase in capital incomes is a major reason why income inequality increased from the early 1990s, and until now. So it's during the last 25 years, I'd say. But this has a different explanations, of course. There are many changes in our economy. There was a substantial credit reform in the late 80s or mid 80s. Then we had tax reform, a significant tax reform that treated capital incomes much more generous than before. So the financial sector is, of course, has a better position to contribute to a development that increases inequality. That's the direct effect. The indirect is, of course, that they provide opportunities for capital owners to avoid taxes in the countries where the people live. So you have these tax havens that were referred to before, and this again might create a problem for the financing of the welfare state, so for the public services, for example, in the future.
So when more and more taxpayers' money might end up in tax havens, we will have less money in order to finance public sector, which is perhaps the most important buffer to equalize inequality.
Absolutely. In order to finance the present welfare state, that will be more costly in the future for several reasons. First of all, our pension system and the aging of the population will require more money used for pensions. And there might be an upper limit for what ordinary people accept when it comes to taxes. That we don't know. And if then a group of very wealthy people don't pay their share, don't take their burden of financing the society and the welfare state, then we might face problems. Yeah, absolutely.
So, how does this lack of information that we see as a trend affect our possibility to measure exactly what we would like to measure and find data? Can you say something about that?
Yeah, that's a very interesting issue, and something that I've learned from Fanny. She is an accountant and knows all these technicalities behind the rules. I don't know much about it, and I even don't know economists who know much about accounting. So it's a separate field, and it's very complex, very complicated. So when the rules become more complex, first the accounting rules, and then the tax rules, which introduce flexibilities for firms to determine their own profit, or what they report as a profit. Then, even though we have access to the accounting of all firms in Norway, it will be hard to interpret, to understand what's the real profit. They both discussed this and explained it very well. So, so what the consequences is that our opportunity to provide basic information for political decision will be weakened. Because when we go to, we have projects going on now in order to understand what's the real income of people that have shares in firms. Because what is reported as tax reported incomes are just a part of it. So, you know, in the conventional income statistics, not all incomes are reported. So we try to go to the accounting of the firms to identify what we believe is the profit. But as demonstrated during this discussion, that's hard, much harder than I believed. So, you know, if this development goes on, then I think that we will have big problems in order to get good measures of an important part of the economy. So, you know, what statistical agencies in Europe can provide in the future, it's hard to say, but it has a clear relationship to transparent rules for the private sector, of course.
So, Fanny, in the municipalities, in the public sector, fair value is a concept which is used already. Are mark-to-market contracts also used in public sectors already? Do we know something about it?
This is not so easy to answer, but may I use one concrete example that shows that these accounting rules that actually is essential in this mark-to-market concept. It has to do with the change in 2005 when these IFRS was implemented in Norway in the private sector. Then within 2 years, FAFO reports that 250,000 employees lost their pension. This pension that is very safe and it's a long-term pension. They lost it within two years. 250,000 employees in the private sector, in the business. Now, and this was just the beginning. Now, no one ever has this good pension scheme longer. Now they have another pension that is behalf of everyone. That you have every employee has the risk for the mortality in the measurement of their future pension. So that's a concrete example of this, how this affects employees in private sector. We had the same in the public sector when similar rules are used by all the culture institutions. Some years ago there was a discussion on the opera and also some ideal private companies that used these rules, and we had the same consequences there, that the pension were so expensive for the company that they have to dismantle it and replace it with another pension for the employees.
You're a professor at a university also, and you teach students. Are the issues we talk about here something which students would normally learn about in university?
No, they don't. Not as I know. They don't learn about all these complex issues related to measurement, and as a consequence of complex accounting rules. accounting has normally not been part of university studies, but you might ask whether they are more concerned at the business schools, but I'm not sure about it, whether they focus on such issues.
I don't think so.
No.
What do you know about the business school and accounting? Do they worry about workers' pensions? Do they and how to protect them? Do they worry about public sector, that money does not end up in tax havens? What do we know about what is taught?
We know that this is in several different disciplines in the universities. So in the accounting studies, they learn about the technicalities of fair value accounting, but they don't learn anything about the consequences. The consequences is in other subjects and other studies, but they don't take into account these Marktomarket accounting rules. It becomes too technical, and therefore it's more a standard subject of income and cost, etc., and socio-economic cost versus commercial cost. So it's not something that you would normally find in a curriculum, I would say.
It seems as also there would be a need for some interdisciplinarity so that it's possible to learn about the consequences and understand how to connect these dots. What do you think?
It's actually quite difficult because it's such a huge and broad area. I mean, Marktomarket is just one area. Then you have derivative contracts, which is a subject that is taught in specialty classes in very late in the education of people. And again, the focus is on the technicalities, how to do it, and not the consequences of these accountancy rules.
It seems as a huge challenge that some of the issues that we discuss here now are so technical and so complex to understand, and that might also be a wanted development, that it is complex and that it is technical in order to achieve financial goals. So what are the key bullet points that a student should take away from this conversation? Or which questions should I ask? Frian?
I think one of the big questions should be, how is it possible to allow companies to dividend out future earnings?
Funny. What key bullet points or questions should a student take away from this conversation, do you think?
I think that they should ask themselves if we want public services for the future. I think a lot of us take it for granted, and I think that is a question to be asked in several occasions, actually. Also in this issue about how the public services are produced and by whom, and why we don't know how the money is spent. I think that would be, and if they could ask their teachers in different issues to explain the consequences on different items or different issues. I think it's this is a subject that is so complicated that it's necessary to discuss together with several professionals. I think that is would be useful.
Rolf, how would which bullet points would you like the students to take away from this, and what questions do you think your students should ask?
I could ask myself, not only the students, because I've been rather ignorant regarding these issues, because I didn't know much. And why didn't I know much? Because accounting doesn't sound very attractive. It's not an area. I'm more interested in wine, than in accounting. But after I realized the importance demonstrated by my two colleagues, I would say that it might have a huge impact on our future, and not least what we have been used to might vanish. We might get a completely different society because we are not able to finance the future welfare state. It's a risk. But as I say, I don't know much about the future, and I don't know other people who know much either, but there is a risk. There is a real risk. Because what is true is what I have told about the opportunities that has been created by this new system, accounting system, and that's a bit scary, I must say. And living in a society as Norway, there is a lot of confidence, related to the system and to politicians and so on, even though they do stupid things from time to time, but we all do. The problem is that politicians might get less and less influence on important decisions. Decisions that are taken by people that are not under democratic control, and I'm really worried about that.
But I think we should say that it is possible to do something about it. It's not something that is impossible. It's for politicians to know about it, and then to know what counter mechanisms you can have. So if you have fair value accounting, that is well and fine, because that is information to investors in companies. The only thing society has to do is to ensure that this fair value accounting does not transfer into cash out from the companies. That's the most important thing, that the companies actually keep the cash, because that cash is a buffer against downturns in markets, and industries, financial industries, other industries will not be as vulnerable if companies are not allowed to dividend out from these unrealized future earnings.
And in order to tackle this complexity and continue and prevent the continued possibility for accountancy rules being developed totally outside political control, the possibility to completely determine which profit you would like, which value you would like, or whether or not you would like to pay tax. There seems to be a massive inertia in the international rules and initiatives. What can a single country do by itself, viewed from an accountant's, in order to tackle this?
I mean, accountancy rules, as they are now made, they are made by these international bodies. It's difficult to create accounting rules that goes counter to these accounting standards. However, it is possible to enter in with these buffer mechanisms, so you can still keep fair value accounting, so that the assets in the company is valued just as any other company. It is when you come to the equity, the effects that these adjustments have on the equity, and what you do with the equity, that is important. And that is why I'm saying that it is possible to forbid dividends from unrealized part of the equity. That is within the possibilities of the national law to go away from fair value accounting is totally unrealistic when the rest of the world is doing it. But you can, as a single individual country, you can do these adjustments to what is allowed to do with the equity or not. And that is also something that other countries will see, because currently there is a mechanism in the equity that seems to take care of this, but all of the effects done by the IFRS standards, they are exempt from these mechanisms, so that they go directly into the dividends, and that's where a single country can do something to protect the equity of the companies, so that they have a buffer in financial crisis or other types of crisis.
Mm.